Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to scroll through Twitter, see what people are sharing on social media. I'm going to interject my financial opinions as we go through it together. It's generally related to three different topics: wealth building, commodities, and or financial topics. So let's just going to dive right in there, take a look, and I'll share my opinions as we go through it. If you want to follow me, it's at finding_finance. And if you want to join our community, finding-value.com, that's where I do question and answer sessions. We do have a question and answer session today at 5 p.m. Mountain Time. If you're interested in asking questions, I will be going over monetary and fiscal spending and what I know about it, how that may impact this commodity cycle. And I will also go through some other information, potentially of what's coming with dollar weakness and stuff like that. The first one, I don't know how to pronounce this, but jet fuel consumption is at all-time records. We can see the aggregate of all of these areas, Asia, North America, basically all of the continents, aggregated up, and we are at about 7 million barrels per day or so. So we're at all-time highs for jet fuel consumption, and I don't see why that wouldn't continue higher. Tavi, now I'm going to dive into this one at the end of our thing here. It's a little bit longer thread. He goes into the macro environment, and then he talks about the depreciation of the US dollar relative to other currencies. And I've been talking a lot about that on the website here. It is what I would consider to be something that is incredibly important to watch, and I do think it's coming. And I'd like to talk a little bit, at least on the question and answer session today, about that transition into it and how it is maybe not so similar to other cycles. And I'll give you guys the data why during that meeting. Peter Lynch's biggest mistake, and you guys have heard me say this on the website of my biggest mistake. I didn't know that this was his biggest mistake as well. This was my biggest mistake growing up, learning how to invest, becoming a better investor with time. This is what he says. He goes, "My biggest mistake was that I always sold stocks way too early." What I would say is I didn't hold long enough. That it's the same thing. He sold too early. I didn't hold long enough. That's how I always thought it. He says, "In fact, I got a call from Warren Buffett in 1989. My daughter picks up the phone and says, 'It's Mr. Buffett on the line.' And I thought some of my buddies are kidding me because she was only 6. And I pick up the phone and I hear, 'This is Warren Buffett from Omaha, Nebraska.' He talks so fast. And I love your book, One Up on Wall Street, and want to use a line from it in my year-end report. I have to have it. Can I please use it?" I said, "Sure. What's the line?" He says, "Selling your winners and holding your losers is like cutting the flowers and watering the weeds." That one line that he picked up in my whole book has been my greatest mistake. I visited the first 4 Home Depots ever built. I sold that stock after it tripled, and then it went up another 50-fold. If you're great in the business, you're right 6 times out of 10, which means you pick 6 out of 10 good companies. But the times you're right, if you make a triple or a 10 bagger, it overcomes your mistakes. And he's talking about asymmetry here. So you have to find big winners. I sold way too early on Home Depot. I sold way too early on Dunkin' Donuts. Why did I do that? I was dumb. With great companies, the passage of time is a major positive. Forbes' 100th anniversary issue. Lynch took over 18 million Magellan Fund in 1977 and ran it until 1990, averaging a 29.2% annual return. His book, One Up on Wall Street, is a great read that I've recommended to many new investors, which includes many simplified investment one-liner quotes such as, "You need about a 3rd grade math education to be a good investor," says Buzz. So again, there was 2 things that I took away from Peter Lynch in reading this that I think you should take. Selling too early and not holding on to those winners long enough is a big one. Number 2, asymmetry that's still with number one, not holding long enough and using asymmetry to really carry you forward. You got to hold it through. And then he says, again, this is number two, if you're great in the business, you're right 6 times out of 10. Those are the two. Asymmetry carries you higher if you're right 6 times out of 10. What does that mean? If you choose 20 companies, you might be right on 12 of them. You might not be right on the other 8. On that 8, you may lose money. You may have a no return at all, or maybe it just barely goes up, which I would consider to be a loser. But on those 6, you have to ride those big winners. That's what gets you the return. You have to hold long and ride them long. Coming down to Peter, he says, this is CNN in 2015. So I talk a lot about using charts, using those charts and buying patterns. We are looking at the herd and we're buying things that are out of favor. We're using the chart pattern and we're looking for those things to buy off the herd and the pattern that they're creating. Because when you look at news, the news it's just going to be whatever the sentiment is at that time. So in 2015, this was CNN. It says, point being, mainstream media is clueless. Media has shunned gold. It was mocked, laughed at by even the bankers themselves, even my university professors. Egos galore. It is going to take some time for the herd to fully wake up. Many will not in time. Many will learn their history from living through it again. And this was back in 2015. In 2015, the article was written here, New York Times, and on July 30th, 2015. Prepare for gold prices to plunge as low as $350. And that was when the price was $1,088. That is what you have to invest against. The sentiment is going to tell you that everything is bad. It's going to tell you that you should sell. Why are you owning this? You are stupid. And everyone will be like that because they use price as a determining factor to describe a situation. The fundamentals or the cycles that we look at has nothing to do with these articles. You have to shut this crap out. Go against it. Look for this and buy this stuff. Not only don't buy it because the sentiment is poor and that's the only reason. We want to look for confluence. We want poor sentiment. We want something that's cheap. We want good technical basing patterns, bottoming out. All of those things. If we get the alignment, that's perfect. And that alignment doesn't come very often in history for these types of bottoms. And they may come once every 10 years or longer, depending on what you're looking at and how fast that commodity or sector cycles through it. Here's Alfonso. He says, I like Valero Energy, VLO, as long as it stays above that shelf of former highs. And we're seeing this in a lot of energy and energy service companies. Valero is a refiner, but we broke through that resistance. You break out and then you do a retest, and everyone knows what I do on retests. I buy a lot of it. I'm not saying Valero here, but I'm using this as an example. There are smaller cap companies that are breaking out of patterns. They're either have done their retests or are doing their retests that are great opportunities to purchase. So that's what I'll say there. Investment books. Here's another one for investment insights. So it says large amounts of money aren't made by buying what everybody likes. They're made by buying what everybody underestimates. And that's a Howard Marks quote. Now I want to read a couple of things here real quick. He says, if everyone likes it, so let me start up here. If everyone likes it, it's likely the area has been mined too thoroughly and has seen too much capital flow in for many bargains to remain. If everyone likes it, there's significant risk that prices will fall if the crowd changes its collective mind and moves for the exit. Superior investors know and buy when the price of something is lower than it should be. And the price of an investment can be lower than it should be only when most people don't see its merit. Yogi Berra is famous for having said, "Nobody goes to that restaurant anymore. It's too crowded." It's just a nonsensical to say everyone realizes that investment's a bargain. If everyone realizes it, they'll buy, in which case the price will no longer be low. Large amounts of money aren't made by buying what everybody likes. They're made by buying what everybody underestimates. In short, there are two primary elements in superior investing: seeing some quality that others don't see or appreciate, and that isn't reflected in the price, and having it turn out to be true, or at least accepted by the market. And at the bottom, he has a closing statement that says, "That's why successful investors are said to spend a lot of their time being lonely." That's because nobody agrees with them. You have to be a lone wolf. You have to think on your own and be willing to take opposing opinions about investments that other people may not like. You have to be pretty independent. Here's NVIDIA CEO Jensen Huang has been cashing out more frequently than normal this month. Sell, 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 sell. Yeah, that's called cost averaging out, buddy. He wants out. He knows it's close to the top. Here's the NASDAQ. Two patterns in play. Diagonal support, which is the white line. That's this guy here. And then we've got former resistance becomes support, which is the blue line going across. And we're at that intersection point right now where we could see some support. It's finally happening. And this is another really big deal. The Russell 2000 is breaking out of its 3+ year wedge relative to the S&P 500. The market conditions are changing here, guys. They're changing some degree, and we could see the Russell 2000 outperform. Obviously, I saw that big breakout in the Russell 2000. I also think that there's some other things that are changing underneath if you're paying attention, where we could see some money flows into some of the sectors that we own too. I want to go over this, bubbles. So Morgan Housel says, bubbles form when the momentum of short-term returns attracts enough money that the makeup of investors shifts from mostly long-term to mostly short-term. That process feeds on itself. Correct. He is exactly correct. And I just want to read the top here. I'll read these two. He says, when investors have different goals and time horizons, and they do in every asset class, prices that look ridiculous to one person can make sense to another because the factors that investors pay attention to are different. It says bubbles aren't so much about valuations rising. That's just a symptom of something else. Time horizons shrinking as more short-term traders enter the playing field. And most of the time, bubbles are formed by FOMO. It's people that want to get in only because the price is going up. They don't know anything else. They just chase price. Here is Hosen. He says, by 2034, your 9-to-5 job will be extinct. Everything will be so cheap you won't have to work anymore. That's Mark Anderson's latest prediction, the billionaire investor who predicted the rise of the internet in 1993. And I'm not going to dive into that one, but that's his opinion there. Insanity, says Justin Hune from Uranium Insider. Since 2000, an estimated 17 million trees have been cut down in Scotland to make way for wind farms. Has anyone contemplated that oil, gas, and coal, and uranium, which is nuclear, maybe those are the cleanest forms of energy? I don't know if anyone's ever pondered that. The environment could be vastly more destroyed with solar and wind. And I don't think people realize that in terms of how much we need to mine materials, how much we have to clear the environment to accept these renewables, in terms of clearing down trees, brush, grass, whatever it is. Investment wisdom, Nassim Taleb. What matters in life isn't how frequently one is right about outcomes, but how much one makes when one is right. That's your asymmetry. And I want to like drill this into everyone's head. Asymmetry is one of the most important things that you can learn in investing. And then you have to have the balls to hold on and have that investment materialize in the way that it can. You can't cut it short. You gotta let it go. And that's what Peter Lynch, Warren Buffett, all of the greats, they will all agree with what I just said there. It says narratives and storylines do not matter, price does. Until the daily chart turns up, this is a wasteland of underperformance in his opinion. That is uranium in a clear downtrend versus the S&P 500. I do see, if you look, you can draw a line through here. I do see a falling wedge. So if we see a break of that falling wedge to the upside, I would be very bullish. I don't really like to talk negative about any particular investment. I look for opportunities. I wait for a bottom, and this is a falling wedge. You've got one hump, two hump, and then a third hump is in there. It's real small. I think we're close to bottoming, but again, we have to wait for this to kind of turn upwards, and then I would get very much more bullish than what I am today. But there are some things that will drive uranium in the future that are tied to Tavi's comments up there that we're going to go back and hit again. Global recovery or global recoverable oil reserves have declined over the past 12 months, down 52 billion barrels year over year, due to insufficient discoveries and downward adjustments in existing inventories. That's quite interesting there. Oil reserve declining. Here's one. This is for silver, and I know people get real worked up if something falls like this, but that's also a slingshot. So don't be too anal on the lines here. The pattern is put in place. It's scribed. It's all there. Even if you break down a little bit and people get scared, it's going to reverse, in my opinion. So it says, although the Livermore setup for silver was there, it has to be said that it was broken by the brutal drop. But we're not throwing in the towel. The miners holding strong, something to watch. I disagree. The patterns are formed, and it's not like that pattern goes negative if you fall and break the bottom trend line here. There's been almost all of these reversals, like almost every time you're about to rip, I call it the slingshot cheetah, where it falsely breaks through all these stop orders. And a lot of people use stop orders right underneath these support levels. It runs through all the stops, the big boys all load up, and then they rip it to the other side. I still think it's good to go, in my opinion. There's copper. What are the experts saying? So let's read through the experts. Analyst at Citi says forecasts copper demand will outstrip supply by 1 million tons over the next 3 years. Upside is possible over the next 2-3 years. Goldman Sachs says, given the larger deficits, we upgrade our 1-year end target on copper to 12,000 a ton from 10,000 a ton. Willis raising our full year forecast average price to 9,800 a ton. It was previously 9,200 a ton, and retain our average 15,000 a ton in 2025. And Jeff Curry at Carlisle says, with copper already up more than 21% in 2024, he forecasts copper to reach $15,000 a ton, or $6.80, $6.80 a pound in the next couple of years, a 46% gain from March 2024 prices. So they're all very bullish if you want to know their opinion. Here is light crude continuing to squeeze up. We haven't broken out of this yet. We did enter this from the top side going sideways here, so we'll see which direction we break here. JC Parrots says, have you actually take the time to count how many stocks are going up? It's currently going to take you longer to do that than at any point during this entire bull market for the past 2 years. The list keeps getting longer, not shorter, in financials, industrials, healthcare, small cap materials that all break into the upside. So that is positive. The chart shows the rotation from the current tech sell-off, which started on July 11th. You can see utilities, healthcare, financials, basically all of the ones that are right here, all break into the upside. Semiconductors, okay, so that one I think was last one. So let's go back up real quick, and I really want to touch on Tavi's thing here. This is really important to understand, in my opinion, because the dollar and the strength of the dollar and that currency against other currencies will determine the value of assets, because the dollar is the denominator that is being priced, that prices the majority of commodities and other things in this world. So, in his view, we stand on the cusp of a major transformation in the foreign exchange markets. The likelihood of a significant depreciation of the US dollar relative to other currencies over the next several years. Allow us to elaborate. I really want to touch in on this. I'm also in this camp. I don't know if it'll be a straight shot to dollar devaluation or if we have to go through a slowdown or something. I'm not exactly sure of the path, but this is big because last time we saw the dollar really drop, we saw emerging markets, Brazilian real, Canadian dollar. We saw all these currencies rip. And that's also when commodities went ballistic. I mean, they went up a lot. Uh, some of these steel companies were, 50 to 100 times from bottom to top. And I think we can buy close to the bottom on them. Some of these other commodity companies and tankers and dry bulk shipping and all these things, we're talking many, many fold increases, 10 to 50x from bottom to top. Now, I'm not saying that everyone can buy it from bottom to top, but if you can get a good chunk of that return, yeah, definitely. So he says the Fed's current interest rate policy is entirely misaligned with the magnitude of the debt problem, putting the US economy in a precarious situation. This issue is notably more severe compared to other developed countries. And here's USA. This is public debt net interest payment to GDP, and we're at 4.6% interest payment to GDP. All of the other countries are not like that. We are pretty big here. As shown in the prior chart, according to OECD, by next year, the US will face by far the highest cost for servicing its debt among all democratic developed market economies it tracks by next year. This predicament has swiftly shifted from a long-term issue to an immediate challenge, and we believe it may force several reductions in the Fed funds rate that call into question the Fed's ability to achieve its dual mandate of maximum employment and price stability. Those are the two things that they measure and use as inputs to their decisions. Such a drastic reversal in policy stance by the Fed is likely to exert substantial downward pressure on the dollar relative to hard assets, but also versus other fiat currencies that do not face the same urgency to reduce debt costs. That is huge, guys. That is what drove the last bull market. They get put in this weird situation. They have to lower rates, and it's going to be at the cost of the currency. And when other currencies go up against the dollar, that is when emerging markets and some of our commodities go ballistic because our commodities are priced in dollars, and those other currencies, when compared against the dollar, will go up. He says, irrespective of the political party in power, the following chart is probably the most important issue in today's economy, which we anticipate will likely have major implications for the US dollar. This is US federal debt net interest payment to GDP, which is 4.1%. It's really, really high compared to history. It's the highest it's ever been. And interest rates are driving that. Well, obviously the total debt load as well, but interest rates are a big driver of the percentage. Net interest payments as a percentage of GDP is projected to reach its highest level in over 2 centuries. Note that the 4.1% figure for 2034 is based on CBO estimates, which historically have been too optimistic relative to ultimate reality. The core of this perspective is that the potential near-term benefits of cutting interest rates to ease the debt burden are tangible and achievable, but also likely at odds with the Fed's long-term goal of low inflation and full employment. While other economies may have worse debt imbalances, none experience the same level of pressure from debt maintenance costs as the US. And he uses Japan as an example here. He says the Japanese economy is one of the most indebted developed nations globally that has managed to maintain an exceptionally low cost of debt through interest rate suppression and yield curve control measures. This approach, however, led to a significant devaluation of the yen. And additionally, observe where debt service levels are today compared to the 1940s, when the debt issue was equally severe. The urgent need for financial repression in the US economy has never been more apparent. So, from a macro perspective, America's exceptional economic growth has been primarily driven by its significantly large fiscal deficits compared to other nations. Since 2009, the US has run the steepest government deficit relative to GDP among any other country. It's currently at negative 8.1% when compared to GDP. That is huge, guys. That's a huge fiscal deficit. We believe this spending differential has spurred growth and attracted capital to US financial markets, explaining why the rest of the world has drastically underperformed for more than a decade. And this is the relative comparison between the S&P 500 and the MSCI. This fiscal exceptionalism has been made possible largely due to the US's dollar role as a reserve currency, which allows the US to pursue a more expansive fiscal agenda than other countries. Given the surging cost of debt, it is reasonable to question whether the US economy can continue to sustain this level of fiscal dominance, particularly in comparison to other nations. So there's three potential solutions have emerged for addressing such a challenge: austerity measures, political tools to suppress debt service costs, and more radically, debt restructuring. The 1940s serves as a relevant example where the US used these strategies, achieving a primary fiscal surplus and employing yield curve control to lower interest rates. Allowing inflation to surpass historical norms also helped reduce the debt imbalance significantly. We believe a similar policy mix is necessary today, with interest rate suppression likely being the most effective initial measure given the current AI revolution, electrification, onshoring, manufacturing modernization, and increasing deglobalization. As Stanley Druckenmiller once observed, one of the most effective ways to strengthen a currency is by adopting a tight monetary policy alongside an aggressive fiscal agenda. This playbook has kept the USD strong, but it is unsustainable due to the current debt cost imbalances. Currency markets behave on a relative basis, and the pressing need for the US to adjust its interest rate policy indicates that the dollar is likely to face adverse effects from this potential changes in monetary and fiscal stance. So the central issue is not the debt imbalance per se, as history has seen even more severe public debt distortions. The real problem lies in the disconnect between the current interest rate policy and the size of the federal debt. To manage the existing liability effectively, substantial reductions in debt service payments relative to GDP are necessary, which is in stark contrast to the approaches taken by other economies at present. So this is public debt net interest payment to GDP because the US is way up there. So it is crucial to pay attention to assets that exhibit resilience despite major macro headwinds that should typically be negative impact their prices. This is exactly what we are observing with most currencies relative to the US dollar recently. I agree with this big time. Multiple fiat currencies have begun to show remarkable strength, potentially marking a historical bottom, despite one of the most aggressive interest rate differentials between the US and the rest of the world. And these are the euro, British pound, Australian dollar, and Canadian dollar. The British pound's already breaking out, and Brazilian real also is bottoming. The positive carry for holding US dollars should be driving a major inflow into the currency, particularly compared to gold and other hard assets. Instead, we have seen metals surge during one of the most aggressive hiking cycles since 1970. These changes in market structure are notable and likely mark the beginning of a trend. We tend to favor currencies of economies with significant exposure to natural resources. Additionally, declining trends in the dollar tend to benefit emerging markets. Agreed with that. So to summarize our thesis, we anticipate that following the chain reaction from entrenched inflation to rising interest rates and falling sovereign debt prices, the US dollar will likely be the next to decline, driving precious metals significantly higher. Totally agree, and we're going to see a drop in the 2-year yield, is what he's anticipating. So that's his research there and the bear case for the dollar. So that's where I'm going to end it, guys. I know that last portion was a bunch, but that's what I've got for today. Give me a thumb up for the content. Don't forget to click subscribe to the channel here. Let's try to boost the numbers up a little bit, see what we can do here to help me out. And if you want to join our community on the website there, we do still have a coupon code MAYDAY, MAYDAY. It's still active, and you can use that for a 50% discount off for the first month and first month only on the monthly membership. And you could also sign up for the yearly membership and get a larger discount on that. And check out my hat, guys. That is a finding value hat. You see that? But that's what I've got for today. We'll catch you later at the question and answer session today at 5 p.m. Mountain Time. All right, guys, we'll catch you later. See ya.